Hi everyone, it's Miguel again with another video from my series 10 Common Wall Street Misconceptions. And the misconception or myth that I'm going to cover today is that growth entitles you to disregard valuation. Now, when people think about growing businesses, for example, Uber, Tesla, that they think that, well, as long as it grows to a substantial rate, then that means that I can pay whatever I want for the business. Not necessarily. And I'm going to break down exactly all of the different ways in which you can truly measure valuation to ensure that you get what you pay for. It used to be back, like prior to the 1980s, that in investment thought, most people usually chose a certain camp that they described to. They would either be a growth investor or a value investor. People like Benjamin Graham and Warren Buffett, they were more towards the value side, whereas everyone from Ken Fisher to John Templeton, I would argue, was more leaning towards the growth perspective. However, it was Peter Lynch, who was the manager of the Fidelity Magellan Fund, which arguably had one of the highest performance rates as a mutual fund manager. He came up with a school known as GARP, or growth at a reasonable price. He believed that growth was an important factor in investment, but so was valuation. And only by comparing growth alongside valuation would you be able to truly be able to monetize how much you are paying, which he believed should grow at a proportional rate in regards to how much it was growing. So he developed the PEG ratio. And the PEG ratio actually takes two ratios. Price to earnings, which basically tells you how many years it'll take back for the company to earn back your investment in income, over the growth rate. And by looking at valuation alongside growth, he was actually able to own about 1,400 stocks at once and traded almost purely based off of the PEG ratio. However, while I do think that PEG is important, I really want to break down what I think are the most helpful metrics to measure valuation, just so that you can get an idea. Now, I don't know if you all have checked out my previous videos where I talk about the cash conversion cycle, but I think that each step of the cash conversion cycle requires a necessary method for measuring a company's ability to keep the cash that you're buying cheap, so that you can make sure that there isn't a specific step in the cash conversion cycle that's inhibiting your ability to earn quality returns. So when we're looking at a company, really the first test that you want to test for is, are they actually selling product? So what the price to sales ratio measures is how many dollars you have to pay for every dollar in sales. As long as they're able to provide a significant amount of sales and they're able to do that at a cheap price, then it's worth investing in. However, we also have to recognize the fact that there are going to be more ratios than just price to sales. First, they're able to move product. Then the next question is, are they actually going to be able to keep that in net income? Net income is sort of like the paycheck of a business. So you look at the price to earnings ratio. And the price to earnings ratio essentially tells you how many years it will take for the company to earn back your investment in terms of its income. So I'd say a common one is probably about 20. That if you see a price to earnings ratio of 20, that means at their current net income rates or their current earnings rates over the last 12 months, that it should take them 20 years to earn back your investment. So you can look at their price to sales, you can look at their price to earnings, but you also should look at their price to book, which is the third ratio. Price to book basically tells you how many dollars you have to pay for every dollar that you get in return. And I know that it might be strange to be thinking about all these different cash ratios when most people really only look at the stock price. But as Warren Buffett put it, price is what you pay, value is what you get. Think of it as like if you were to invest and buy 10% of Google, you would own 10% of Google's cash, or you would have a legal claim to it. So when you're investing in corporations, you're actually just purchasing other people's cash. And other people's cash can be expensive because if it's held in the hands of certain people, they might be able to grow it at a much faster rate. But if you're buying something and they don't have a lot of cash, then you could be overpaying for a business even if they are in fact growing at significant rates. So think about that when you think about investment, that you are actually buying somebody else's cash for a specific price. And the way that you make money in the stock market isn't necessarily looking at the popular cash that everybody else is trying to chase after because you hear a certain company's name on the news or it comes up a lot in Google searches. The thing that people actually want on Wall Street is cash. And even if you find a company that hasn't had a skyrocketing stock price, maybe they haven't had a lot of news, or they're just a startup that doesn't have a lot of time to have been building their brand, that for whatever reason, there are a lot of companies that are extremely profitable, but yet they're not popular because people are trying to follow the popularity trends versus following where the profit is. So if you can break down which corporations are actually doing the best job of providing you cheap cash, eventually they will become popular as long as they continue to grow. You have to hold out on the whole popularity game that everybody's trying to play because you're here to play the bargain hunt. You want the greatest amount of cash that's growing at the fastest rates at the cheapest possible price. And these are the tools that you can measure to ensure that from every aspect of the cash conversion cycle that they are offering you cheap cash. The final one that I like to look at is price to free cash flow. And what that tells you is how many dollars you have to pay for every dollar in actual cash that the company has on hand. So the price to sales measures how many dollars you have to pay for $1 in sales. Price to earnings tells you the number of years it takes to earn back your investment in income. The price to book, which tells you how many dollars you have to pay for every dollar of the companies you get in return. And the price to free cash flow tells you how many dollars you have to pay for every dollar in literal cash. So price to sales tells you how they're actually selling their product and whether or not you can make sure that you're not overpaying for their sales. Price to earnings, how many years it'll take for them to earn that back on the income statement to make sure that you don't have to wait too long for your investment to be earned back. The price to book ratio, which tells you how many dollars you have to pay for every dollar you own in return. And what that ratio tells you is that it ensures that you don't overpay for what a company actually owns. And then the price to free cash flow to make sure that they actually do have the cash on hand to continue operations and that they aren't stuck in a liquidity trap. So now that you understand that all of those factors are going to be put into account and that just because a company is doing a phenomenal job at growing their sales or growing their income or their free cash flow or their equity, that doesn't mean that you can have a blatant disregard for their valuation. And when you're looking at valuation, I would say that there's really 4 things you need to look at. You need to look at the market as a whole. You need to look at their industry, their biggest competitors, and their own historical data. So if you see that they, for example, have a price to earnings of 20, that doesn't really tell you anything unless you compare how cheap you can buy their cash compared to all the other stocks in the market, all the other stocks that are in their industry, maybe 2 or 3 of their biggest competitors that maybe they'll give you a cheaper price, or looking back at how much people have paid over the past and seeing if you're actually able to buy it at a historical low or if you're going to be forced to buy it at a historical high. So if you see a company that's growing, you have to understand that there are so many other factors that need to go into investment, more specifically valuation. It's the biggest thing that Warren Buffett looks at. It's one of the biggest things that you can learn in traditional finance is how you evaluate a business. And the way that you evaluate the business is by using every single metric that you go through in the cash conversion cycle of increasing sales, increasing income, increasing book value or equity, and increasing free cash flow, and then measuring the company's ability to do that along their opportunity cost of buying the entire market, of investing in other people in their industry, of their biggest competitors and their own historical data. And if you do that for every single metric and you can compare them and look at all of your opportunity costs, you can not only just invest in the companies that are giving you the greatest growth rates, but also determine which corporations are going to do it for the cheapest possible price. Thank you again for watching and stay tuned for my next video. Thank you.